Appreciate it. Good information, Bora. Good information, Brad. They left me with the fun part of the evening. You know, everyone likes to talk about this market, I'm sure. So we'll get through it together. I want to kind of lay kind of a little bit of groundwork or framework. So we utilize a lot of our charts and our indicators are from Ned Davis Research. Ned Davis Research is a world-renowned research provider known for objective, data-driven approach. They take 4 pillars of the market, and we look for a balanced and weighted evidence approach on where the market may be heading and where opportunities and where risks may lie overall. So the 4 pillars are, macro, that's economy trends, fiscal policy, monetary policy. Those are more expectations, how the market should be acting, but it's more bigger picture and slower moving. So macro can be decoupled from what the market's actually doing for a long period of time. The same thing with fundamental as well, which is basically company earnings. So they can be well away from historical means or norms, but that's still something underneath the scenes that will come to light at some point in time in the future. Faster moving indicators or how the market is actually acting is more technical, which is like momentum, volatility, trends, volume, and sentiment, which is crowd psychology and investor behavior. So I just kind of want to review that real quick. Just to send the groundwork. I'm going to go through each of the investment pillars. I picked a couple different charts from each of the different areas to kind of explain the story of the market, if you will, and maybe where we see things heading or what's happening overall right now. So I'd like to review this, and if you were on the last call or you've listened to me before, I usually start with this because I think it's good conceptually to understand normal economic and market cycles. They don't always exactly go this way, but it happens to be that the time frames on this and this last market cycle has pretty much played out to a T. I'll start on the left-hand side. We start out with some kind of recessionary bear, which eventually gets into a recession, which we can think about that as COVID. It was a very short-lived recession. We got to extreme pessimism. When everyone is pessimistic, that's actually a contrarian indicator. So that makes the bar really, really low, and everyone's expectations are really low. So coming out of a recession, we have a really, really strong rally, usually lasts 1 to 2 years. So you think in your head, late 2020, 2021, that's a period of extended mean reversion, multiple expansions on earnings, but eventually the market gets overly optimistic and gets overbought, and that leaves us complacent for some kind of market downturn. Lots of times coming out of a recession, eventually we get in our heads like, well, what if we are going back into a recession or the economy is not as strong as it is? So it's very, very common in a market cycle to have what's called a echo bear. And that's a non-recession echo bear, which means we think we're going into a recession, but we don't actually get into the recession. So now think in your head 2022, where the market goes down, 22%, but we don't actually have a recession. And that gets us to the point where we're, again, very, very pessimistic. And so we had extreme pessimism readings in September and October of 2022, which sets up this longer term, potentially post-echo bull. It's not as strong as this post-recession bull because basically a non-recession echo bear doesn't go down as much. A recession bear goes down 35%. A non-recession bear maybe goes down 20, 25%. And so since we don't go down as much, we don't have as much mean reversion. We also, since the recession didn't happen, we don't have as much stimulus overall. And so this is generally the longest period of a secular bull market, which can last from 6 months to 5 years. And so that's where we believe we are in, but it can last, like I said, any time from 6 to 5 months, years. And once this echo bull is over, guess what? We start over back into the recession and ongoing, but this can be a very long period of time. So technicals, again, technicals are momentum, volatility. It's telling us why the market is acting a certain way. So you probably thought about the election maybe and been talking about it or heard about it. I know I hear about it all the time. It's coming. Well, there's 2 rough parts in a normal cycle for an election cycle. And this is average market returns in a 4-year election cycle. And there's 2 rough patches. One rough patch is before eventual presidential election, which is where my mouse is November of next year. So it starts kind of right where the market peaked out in July. And generally we go through a rough patch until October, November, and we end with a year-end rally, but we're more range bound. Historically, the market actually starts to get it together closer to election, which may sound counterintuitive or maybe counterintuitive with this election coming up. But once some uncertainty is relieved from the market, generally we get some momentum from that overall. Well, the second roughest patch is actually starts to be the year before midterm elections. And the market at the end of that year starts to go down on average and is mostly range bound until we actually get into midterms and we have more certainty again. So we're in what is a normal rough patch and just an election cycle anyway. However, most years do end on year-end rallies, and that just has to do with seasonal weakness. And now there's some other indicators that I'll tell you why I still believe that a year-end rally is on the table and a very, very good possibility overall. I think you have to understand kind of the market where it is right now. This rally coming out from September to now has been significantly narrow, meaning the whole market really hasn't participated in this market. It's really just been, 6 to 10 stocks that have really got really good gains that did terrible in 2022 and have done really good in 2023 as a mean reversion. Also supported with some AI optimism that's really kind of propelled that overall. But it's not healthy for a market to just lean on a few stocks. So this is the percentage of S&P 500 stocks outperforming the S&P 500 over the past 3 months. Generally, we're at 50%. And anything above 50%, it says, hey, well, that's a healthy breadth of a market. Most stocks are participating in this movement overall. And we did get that coming out of September. But in June, and I talked about this in our last webinar, only 16 or 18% of stocks in S&P 500 were actually outperforming the S&P 500 at that time. All of it was being carried by just a handful of stocks overall. And historically, for a rally to continue, we need the rest of the stocks to join the party. So that started to happen. It's waned off a little bit with the consolidation period, but this is healthy for the rest of the stocks to join the party. So right now, about 10 stocks make up 30% of the market capitalization of the S&P 500. Historical mean is 22%. So there's a lot of basically faith in only 10 stocks overall. And I'm saying that not to be worried necessarily. I'm saying that there is an opportunity potentially. Like when we look at the S&P 500, it is up for the year. But if we look at the Dow Jones Industrial, it's pretty much flat for the year. If we look at an equal weighted S&P 500 index, it's pretty much flat for the year. So there still is room for improvement on a broad market basis. So this just gives you some statistics. This is kind of what would happen in a year where the first half of the year we're up by 10% plus, which has happened this year. Generally, we have a weak third quarter. So the third quarter on average, when the market's up by more than 10%, is down about 5.7% is the mean. However, the fourth quarter after that occurs, the average mean is 6.8% up, and that happens 80% of the time. So is that going to happen this year? History from a technical basis, some technical things are showing that this could possibly occur. This is a normal cycle composite just for the year. And I brought this up in our last July meeting. And there were two things I was concerned about in our July meeting. One was I liked that the market was broadening out. So I said that was a positive. But two concerns I had was the cycle composite usually peaks in this year from an election cycle and even on a normal basis around July. And then August, September are seasonally weak months, even September, October. But October, November starts to get stronger, and November, December starts to get stronger as well. But also there was excessive optimism at that time, which made us a little bit complacent, and we were due for a consolidation or a correction. We've had that, and some of that sentiment has definitely gone down from the excessive category, which I'll show you in a little bit. But this is the same thing I had last webinar in terms of like in the mid-year, we said these were the risks in the second half. And now that we're a little bit further in the second half, I thought I'd review these. Economy slowing, and really the economy's still chugging along. This third quarter GDP estimates are pretty high right now by the Fed overall, and the economy's been pretty resilient. Fed hikes, well, that's still going on. Earnings per share expectations, we actually had a really good quarter in terms of earnings beat rate. Excessive optimism was a risk, but that's waned off. So now we're more in a pessimism zone. So that's actually good for a year-end rally. And potential for the second half. The banking crisis hasn't crept back up, but we haven't gotten this broadening that I wanted to really get. And if we get this year-end rally, we'll really be looking at the broadening of the overall market. So this is just some basic technical analysis, nothing real complicated here. We had a 200-day moving average on the stocks, which puts us right at the 4,200 level for critical support. It also goes up against a couple peaks in the past here. So when we were looking at the market and how much this correction or consolidation period, we knew there was going to be some support here at 4,200. Now this is very recent. This happened, what, 4 days ago, 5 days ago? We touched the support, we bounced off it. We've had 3 days up, 4 days up maybe. We'll probably hit some resistance, but I wouldn't be surprised if we hit this 4450 area just purely from a technical basis. However, this bull market has been weak. It's the second weakest bull market in the last 50 years. Weaker bull market was in the 80s, but the next year followed up with like a 27% return. We were a little slow out of the gate overall. One, because I don't think we had much of a bear market. It may have felt like a really bad bear market from historical terms. That non-recession bear market was on the light side. Like we barely got over the 20% mark. So we don't have as much mean reversion. So I think that's part of this overall. But the S&P 500, we were getting close to kind of historical averages, which is the blue line, but we've waned off a little bit. Cyclical growth sectors have been kind of right on average. Cyclical value sectors have been underperforming a bull market average. And then defensive sectors, which you would think that they would do well if the market is really worried about a recession, but the recession has been pushed out. We think really in 2022, we pushed out to 2023. Now we're pushing it out to 2024 at the very least. But also with the defensive sectors, there's also another game in town, which is you can get a nice yield from just treasuries and money market and bonds overall, that you don't need to get into utilities and staples to get a good dividend yield necessarily. So there could be some, these are probably the cheaper sectors of the market overall in terms of valuation, even financials. But so far this has been kind of weak. So I'd like to see things kind of broaden out. So this is basically what I'm talking about with the breadth of the market. So this is the percentage of stocks that are over their 200-day moving average. And so when coming out of when September of last year, we had a run, and in January, February, we hit a little peak here. There's a little pullback in March, and then we hit a peak in June and July. Now we're looking for this to retest. So we'd like this broadening here to happen and be higher than these last peaks. Otherwise, we may be going through a topping process where we get lower highs on a breadth basis, meaning stocks participating in the overall market. And that would indicate not as healthy of market. So that is kind of yet to be determined at this point. All right, fundamentals. So fundamentals, you buy stocks create earnings, stock creates cash flow, dividends. So you want to be cognizant of where they are from a valuation standpoint. The good news is, and I had this chart last time, but I updated because we have a new quarter's number of earnings, is that 80%, and that's these lines here, is the percentage of S&P 500 companies that beat their earnings estimate. And for a couple quarters here, we've been on an upward trend overall, and that's actually positive. So we actually had a pretty decent quarter in terms of earnings. What's not as good is that on the top line, we're having a little bit of trouble. So on the sales beat rate, it's actually gone down. So earnings are up and sales are down a little bit. Now, this is still above history if you look in the past. So it's not necessarily something to be saying, oh, well, that means we're going into a recession immediately. No, I just think what it means is that the economy is not growing significantly. We're just kind of treading water and going sideways. The reason earnings have gone up is because companies are pretty resilient and they've gotten better at a couple things. They've been better at cost containment, cost of goods sold. They're understanding the inflationary environment and the supply chain interruptions. They also have a new income source, which they didn't have before, which is companies that are cash rich now get interest income. So there are things helping out earnings rates overall, but we'll be looking at the sales beat rate, moving forward. So our stock's cheap, one measure is price to earnings ratio, and this can be out of the line with the overall market expectations, but on a 1 year forward earnings ratio, I would say based on a mean, they are expensive. We're at this 19 level, and on a mean basis, should be at like 15.3. On an operating ratio, we're pretty close to fair value. On a last 4 quarters basis, we're pretty close to fair value. But this is a little bit misleading up here because remember I talked about the narrowness of the market. When I take out the top 8 companies, the actual valuation of PE ratio is actually much better and we're more at fair value overall because the top 8 companies make up 28% of the market, 28% of the S&P 500, but they only contribute 17% of the earnings of the S&P 500. So they are being weighted higher, by the market in terms of their market cap, but not contributing as much in terms of their weight equal to what earnings they're producing. And some of this has to do with the hope and the promise of AI and maybe some movement to the mega cap because they did so bad last year and there's some mean reversion overall. But a lot of the market is fairly valued. From a valuation standpoint, I could argue that some of the elite 8 may be a little overly valued in comparison to a historic mean. So I think this is one of the biggest things right now that stops the market from moving up significantly is that the S&P earnings yield is now higher than a 3-month treasury. And this bottom chart is basically the S&P earnings yield minus a 3-month treasury. And you can see it boosted up way up here. And we're actually in a negative territory. TINA is there is no alternative. When interest rates were 0, there was no alternative to the stock market. The term was cash is trash. Everyone should invest in stocks. Well, now it's Terra. There are reasonable alternatives. You do make money on your cash. And that affects how much valuation we want to put on the market overall. However, there has been periods of time, if you look in the 90s, where we were at a negative rate here. And the 90s is the perfect example of a soft landing. So the mid 90s, it was the end of an interest rates, cycle where the Fed was tightening and then they were lowering rates and they achieved a soft landing, no recession. Now, a lot of that had to do with earnings. And earnings where companies were multiplying very quickly because it was this birth and the beginning of the internet and these tech companies. And you could translate that to maybe this is the beginning of something with AI and producing more productivity and increased margins. So there's only 1 or 2 ways to fix this and get back into a positive territory. Either earnings go up or a combination, or interest rates go down. Either way helps out the earnings yield versus the treasury yield. All right, macro. So macro, I think, is the most talked about things. It's the most dinner conversation topic because I don't really hear people talking about earnings yields and PE ratios at dinner, but everyone does like to talk about when are we going into a recession? Are we going into a recession? Are interest rates crippling us? Is the economy resilient? Like most of it revolves around macro. So this can be decoupled though from the market on a pretty long period of time because we look out not what's happening now but what we think is going to be happening, and then the market makes adjustments accordingly. So there's some good news here and there's some mixed news here. The good news is globally, this is a recession probability model. It's gone from a high probability to a low probability, and that is good, meaning the economic numbers from a global standpoint have gotten better over the course of the year. And generally when it's in this area, that's when our best returns are. Out of all the different areas in this low probability model. Now, there are some parts of the world that aren't doing great, like the Eurozone, but there are parts that are doing good, like India and emerging markets. And the US is actually holding on really, really good. So from a global standpoint, we're holding in there, and the probability of a recession at this point is, we feel, is low. Could that change in 6 months? Could that change in 9 months? Yes, but right now we're in a low probability section. So given that, we have to think about, the market's really being looked through the Fed's eyes, and everything, I think, comes back to the Fed and comes back to interest rates, because it affects the valuations of the market, affects whether we really think we're going into a recession or not. We believe that we're closer to the end of the tightening cycle than the beginning of the tightening cycle. Could that mean one more rate hike, two more rate hikes? Sure. But more than likely, we're near the end. And I'm going to give another chart that supports that. But to give you some context, this line is when the Fed hikes rates the last time, and then what the market does after that point. So historically, we actually get a rally, but then it fails, because generally the Fed has done a bad job of over tightening and pushes us into a recession. And I know that's not what everyone wants to hear, but that's just what happened in history. There has been cases of soft landings. But however, since Greenspan, I highlighted here, since Greenspan actually occurred, the market's actually been positive once the last rate hike has occurred, except for in 2000 here. And again, 1995 is our best case for a potential soft landing, where 126 days later, the market was up 18%, 252 days later, the market was up 35%. So we have to keep that in mind, that there still can be some legs to this overall. The economy is not at a near recession point, and there could be some bullish tailwinds as well. So just want to keep that in mind. Credit conditions is kind of a boring chart. I brought it up because I brought it up last time. This economy functions on free flowing capital and credit. It's fine. It's actually come up since the March banking issues, and kind of holding steady more in a historical norm of what it was from 2012 to 2020. So interest rates haven't affected the credit conditions as of yet. The consumer's popping up a little bit, on consumer debt overall, but it's still below a historical average in percentage in terms of income to debt overall. One of the big misses, I think, that people had this year was the amount of stimulus that occurred, and it was kind of a stealthy stimulus. So Social Security is 1/5 of the line of the budget, basically, and there was an 8.7% increase in Social Security, so that gave $100 billion of stimulus this year. And we're going to get more stimulus next year, where Social Security recipients are going to receive another, I think, 3.2% overall. It's going to be coming down, but it's still going to be stimulus. As well as tax brackets gotten wider due to the inflation. They expanded all the tax brackets, so some of your money wasn't taxed at a higher rate. And a lot of people had capital losses from last year, so that saved on some capital gain taxes. So there was some kind of stealthy stimulus that happened that wasn't really headline news, and we'll still have some next year with a Social Security increase. So inflation, how long will this disinflation last? So this is the rate of inflation here. You can see we went on this peak here. We've been coming down. We ticked up a little bit here, but that's completely normal, but the trend is still down. The tough part is going to be the last 1.5% to get where the Fed wants to get to. We've come down pretty good, but the last part might be a little bit stickier. The year-over-year comparisons aren't going to be as easy. Most of the supply chain has been fixed, or we've been working with that, overall. So really, the inflation is here, but it's come down pretty significantly, and more manageable level. Historically, when inflation gets really high here, what usually wipes it out is a potential recession overall. But we're not seeing any of that on our economic indicators, and hopefully the Feds learn from past policy making runs that they can navigate this in between inflation and the economy overall and interest rate environment. But we do think we're still in a low inflationary environment that's popping up. Generally, that's when we have the best type of market returns. More than 75% of central banks have paused. Last time I showed this chart, we were up here. Now we're down here. So only 23% of banks have actually raised their rates in the last 8 weeks, the US being one of them. So most of the world right now is kind of on the pause already. I don't think we're too far off from the pause. However, not too many have actually lowered rates. There's been a few, but not too many overall. If this gets down, this clip gets down here, and this gets down to here on the bottom clip, that's generally your best market returns from a historical standpoint. So this is Federico's favorite chart because it just looks awful. Every time I see this chart, I'm like, oh, I got to explain this one again. So there's the Fed funds rate at 5.5%, and there's inflation at, let's say, 3.7%. The difference between the two is the real Fed funds rate. Well, we started out where we've never had to start out before, where basically we are at 0% interest and we had all this inflation. So you could borrow money next to nothing, but you still had this inflationary environment. So it was a negative real funds rate. So no wonder, we were pretty resilient in all these things. But generally, we don't start at this low. So the Fed had to work a lot to get us to an area where the real Fed funds rate was actually positive. And the real Fed's funds rate being positive actually then gives some restriction, makes it sufficiently restrictive financially. And so we're at that point, and we're actually a little bit above this point. This was as of 7/26. They haven't updated the chart as of yet. When we get into this range here, which we're not that far off, generally that's enough to be restrictive economically. And that's generally, all these lines are past tightening cycles. And that's when usually the Fed calls it quits in terms of raising interest rates. And we're there. One more rate hike or inflation comes down a little bit, we're there basically, overall. So since we're talking about that, I get a lot of questions about bonds, and I get a lot of questions about when are they going to do something. And lots of times they do something well before the Fed says they're going to do something. So this is what generally a 10-year Treasury note does between the last rate hike to the first rate cut. And generally there's about an average of 6 to 8 months between the last rate hike to the first rate cut. So even before the Fed says we're going to cut, even before the Fed says we're going to pause, the market sniffs it out and basically will take off 0.75% off the 10-year Treasury. So already bonds are starting to appreciate at that point in time. So the market doesn't wait for that to occur. They anticipate it, and either it comes to fruition or then they have to kind of backtrack overall. This, I think, is probably the most powerful chart of all of them, because this is why I think we are at where we are. When you think about the 80s and high inflation and then going into a recession, one thing they didn't have was this massive amount of stimulus in the recession. And we are still working through that stimulus. This is estimated cumulative excess savings since April 2020. And there's still an extra $1 trillion out there above the linear trend line. So yes, the lower class is getting hit with inflation and it's squeezing their wallets, but they're fully employed. So they're making money and they're spending money. The middle class is actually saving money, and as a percentage of their overall income is going up because they're actually making some money on their money in terms of cash sitting at the bank or in money market funds. Same with baby boomers as well. So interest income is actually going up. But this is what keeps us in the game, and it's a very, very dangerous proposition to kind of bet against the American consumer overall, especially still with this much excess cumulative savings. So sentiment is crowd psychology, investor behavior. It's very contrarian. It feels the exact opposite of the way you feel. I'll just explain this a little bit. When this is up here, that's excessive optimism. That's when everyone is really excited about the market. They've already bought into the market. Maybe they're getting very complacent overall, and that sets us up potentially for some kind of correction or consolidation. Where extreme pessimism is the exact opposite. Extreme pessimism, if you're already pessimistic and you had plenty of time to be pessimistic last year, you sold, you haven't got in the market, you see the market go up a little bit, you get FOMO, you want to jump in, and that pushes up the market even higher. So we were in extreme optimism in July in our last webinar, and I said, well, really, we're due for a consolidation, we're due for a correction. 5 to 10% would be healthy, and it would take off some of the optimism to get us into a pessimistic zone to continue moving forward. Well, that's happened. We've gone all the way down to extreme pessimism, and that's where our best gains are. And that's what sets up an end of year rally, getting into the extreme pessimism zone from roughly a bad August and September. Would I have liked this to come down a little bit more? Yeah. And so that's why I'm not completely confident that the rally is starting right now. But we are in that extreme pessimism zone, which may give us a nice lift here. This is on a more shorter term basis. On a more intermediate term basis, September of 22, we got as pessimistic as basically the market was in the middle of COVID, which we didn't see a recession at that time. We saw no need to then pull back in September of 2022 because there was no recession and there was extreme pessimism, which we knew set up this rally going on. Although it's been weaker in some areas, we like it to broaden out. It set that up. But we went all the way to this extreme optimism zone. And if you can remember back to my very first slide, we do this over and over. I'm not in the screen, over and over again. Extreme optimism, extreme pessimism. So now we're back in a pessimistic zone. I wouldn't be surprised if we get back into the optimism zone. Generally, the first time in the optimism zone isn't a rally killer, and we can stay there for a long period of time overall. But this is kind of setting up this potential rally at the year end. So I'm sure that was a lot to digest. These are my final thoughts. The market is looking through the Fed's eyes. Monetary policy is restrictive. Most of our economic indicators say that we're heading away from a recession, but it's going to be difficult for inflation to get down to 2%. And so the market is worried about the Fed and the Fed overdoing it. And the next year may feel stagflationary, which means slow growth overall. And that's kind of what you want for now until the Fed actually reverses course. Because if the economy is too hot, inflation comes back, the Fed pushes interest rates up. The economy is too slow, we go into a recession. So they will have to thread this needle between the recession and inflation risks. Bonds should become a lot more competitive once the Fed pauses. Bond pessimism is actually higher than stock pessimism. And when that happens, usually bonds actually outperform stocks. So there is some traction there overall, and we think there'll be a potential good environment for bonds potentially next year. Right now, our recession watch indicator, which is 10 different indicators, only one of them is flashing, and there's generally a lead time associated with it. So we don't see kind of imminent recession 2023. Potentially there could be one, down the road. But this market kind of, the way we're trending is following the tendencies of a secular bull. And until that's broken, then I think you should stay put in kind of the investment allocations you have, and that, there still could be legs in the market overall. So that is all I got about the market. I'll turn it back over to Federico and see if there's any questions.